Hi, welcome to video 2 for Module 8. So in video 1, we were discussing property. This video will talk more about infrastructure and a little bit on alternative assets. So in video 1, we were mentioning infrastructure. These are our essential products and services to support our economy and social activity. So the ones we'd be most familiar with, for example, the electricity wires. You may have those outside where you live. Gas, we're not lucky enough to have gas in our street, but I know it's nearby. Water, we all need our water. Energy pipelines, other types of infrastructure, for example, would be airports, toll roads, seaports, and communication infrastructure. It's got a very strong strategic position because it has a monopoly or duopoly. It's cost so much to create this infrastructure that there are very high barriers to entry for other competitors. Substitutes are very hard to find, so infrastructure faces less competition than many other assets, and that means that they can enjoy more predictable cash flow and growth. So we divide infrastructure into two categories: regulated assets and user pay assets. So regulated assets, for example, water, electricity and gas, we've got a regulator that determines the revenue that the company should earn. So if they earn too much, they have to return some of it to its customers by lowering prices. If they don't earn enough, they get to increase the prices for us to pay. Demand is steady for these services, and as the regulator determines revenue, it means that they have a very stable cash flow profile over time. The regulator every now and then takes into account inflation and bond yields, so that means that price rises are linked to inflation and long-term valuations and keeps them relatively immune to changes in bond yields. The other type is user pay assets. So this pricing is usually set by contracts, but the volume and therefore the revenue is determined by how many people use them. So I've got a picture here of Lane Cove Tunnel. So how many people are actually going through the tunnel will help determine the income that they receive. So these types of physical assets, railways, airports, roads, communication towers, they're moving people and goods and services throughout our economy. So as the economy grows, demand for these assets tend to grow. So I remember when the M2 was built. It doesn't seem that long ago. Could be nearly 30 years now. And then since then, we've had the Lane Cove Tunnel built, and now we've got the North Connex going north. So as demand is growing, they're building more and more of these, but it's being built privately so that we get them faster, but then we have to pay. So returns on infrastructure, the income it could be income coming from what the regulator says. So if it was water, electricity and gas, it could be determined by the contract. So for example, oil and gas pipelines, or it could be determined by the number of users, so toll roads and airports, or it could be a combination of these. The great thing about infrastructure, it's got such a long useful life, and the regulatory contracts or concessions, they provide a return over quite a long time period, and it's very stable, and it may also be linked to inflation, so you're protected from that. So the dividends of infrastructure companies are generally backed by a relatively stable cash flow and that comes from the underlying asset. So if you've got an infrastructure managed fund, they can provide access to a global portfolio of listed infrastructure. So you could choose one that's international and be able to diversify by accessing the infrastructure in other countries and different sectors. What are some of the characteristics of investment in infrastructure? So low volatility. These assets are essential. Demand is relatively stable, so there is low volatility compared to traditional equities, and there's resilience on infrastructure revenue during the business cycles. Even when we have times of economic weakness, consumers are still using water, electricity, and gas, drive cars on toll roads. Okay, maybe not during COVID. We did stop driving our cars then, so the toll road infrastructure may not have done so well. But on the other hand, we were at home using water, using electricity, using gas, so that demand continued on. It has a stable cash flow. They've got predictable income distributions because they've got stable earnings from that asset. If it's coming from regulation and long-term contracts, then that's giving stable cash flow and greater stability. So this is an excellent thing for an investor. You've got visibility over revenue and dividends. There's often inflation protection. So we mentioned that before, that the contracts often have an explicit link to inflation. So that gives protection to the investors. Infrastructure can be fantastic for diversification. Remember, it's also got a lower correlation to shares, to equities, and to bonds. So the underlying return streams are linked to the regulations or the contracts instead of what else is happening in the economy. So when there's market stress, think about March 2020, our share price, the stock exchange prices dive down, but tolls and infrastructure, any infrastructure asset, it would have remained stable. Liquidity, it's not directly available to purchase in infrastructure. You'd have to do it through a listed or managed fund. So we've got our asset classes: cash, fixed asset, property, and equity, and then we have got our alternative asset. So what is the return on this? Will we get an income? Will it grow? It's mixed, whether you'll get an income or a growth. Examples, what are we talking about when we're discussing alternative assets? Hedge funds, derivatives, collectibles, commodities, currency. They're examples of alternative assets, anything that doesn't really fit into those other categories. So what do we consider a traditional investment, and what would you consider as alternative? Think about all the different types of investments we've discussed so far this semester. Which do you think should belong where? So which one would you put shares in? Is shares traditional or is it alternative? What about cash? I think we can safely say that cash is very traditional. What about property? What about the other types of assets, investments we've discussed? So traditional, we would consider to be cash, bonds, which is our fixed interest, property, shares, Australian shares, international shares, we'd consider those to be quite traditional. Alternative, commodities, infrastructure. Now, infrastructure sort of could go either way, but we're leaning towards making it alternative. Derivatives, collectibles, and cryptocurrencies. I know some of you like cryptocurrencies. You're braver than me, but that's definitely on the alternative side. Let's have a look at commodities. So what are commodities? These are all our raw materials that we are using. We're either to consume our food, or perhaps we're using it for building or to create other products. So it could be sources of energy such as oil or gas. It could be natural resources, timber, agricultural products that we actually eat, wheat for example, or perhaps it's a metal that we're mining, gold and platinum. So commodities, we would normally use these categories: metals, energy, livestock and meat, and agriculture. So metals, we'd be familiar with metals: gold, silver, platinum, copper. Energy, that's our crude oil, our heating oil, our natural gas and gasoline. Livestock, meat, so pigs, cattle. Agriculture, corn, wheat, rice, coffee, cotton and sugar. those kind of things. That would fall into the agricultural category. So to invest in commodity, there are different ways that you can do this. So you could purchase actual physical raw commodities. For example, perhaps if you wanted some metal, you could buy gold. You could buy gold in the form of jewelry, or buy the gold bullions, or you could invest with future contracts or exchange traded products that have that theme of metal. Now, if they could be tracking a specific commodity index. So these are highly volatile and complex, best for sophisticated investors only. Or another way to expose yourself to commodities, you could use mutual funds that invest in commodity-related businesses. So, for example, an oil and gas fund owns stocks issued by companies involved in energy exploration, refining, storage, and distribution. That would be another way to do it. What are some advantages of investing in commodity? Well, once again, we have diversification of your portfolio. So over time, commodities and commodity stocks, they provide returns that are different from other stocks and bonds. So if you have assets that don't move in lockstep, so they're not moving the same way, that's what we're talking about with correlation, that can help you manage market volatility. Diversification doesn't mean that you're going to get a profit or guarantee against loss though. Another advantage of investing in commodities is the potential returns. Now this can fluctuate depending on supply and demand, exchange rates, inflation, what's happening in our economy. So recent years we've had increased demand due to massive global infrastructure products. So that's influenced the commodity prices. A rise in commodity prices is usually a rise in share prices of companies in related industries as well. And another advantage of investing in commodities is a hedge against inflation. So as inflation rises, the value of stocks and bonds can decrease. So inflation can mean higher prices for commodities. So commodities have shown strong performance in periods of high inflation, but remember that they are also volatile, much more volatile than other types of investments. Risks of commodity investing. It's not all positive. So principal risk, commodity prices extremely volatile. The industry can be severely impacted by world events, import controls, worldwide competition, regulations, economic conditions. Volatility. So mutual funds or exchange traded products, they're tracking a specific sector or commodity, so they can have higher than average volatility. There's foreign and emerging market exposure. We've got asset concentration. So commodity funds can play a role in diversification, but they're not diversified themselves. They are strongly they're focusing on one sector. So they're concentrated. So changes in the market value of a single investment could cause greater fluctuations than would occur in a greater diversified fund. And there are other types of risks. So we may have commodity-focused stock funds using future contracts. So these are extremely volatile. We've got derivatives. This is a financial contract that derives. So derivatives, the word derive is what we're talking about here. So the contract derives, it gets its value from an underlying asset. So the buyer agrees to purchase the asset on a specific date at a specific price. So when the price of the underlying asset changes, so does the value of the derivative. Remember, it derives its value from an underlying asset. So derivatives are often used for commodities, oil, gas, or gold, or currency or other assets. The contract seller doesn't actually have to own the underlying asset. They can just fulfill the contract by giving the buyer enough money to buy the asset at whatever the prevailing price is at the time. They can also give the buyer another derivative contract that offsets the value of the first. So That makes it easier to trade a derivative than it is the actual asset. They're not a product, it's a contract that derives its value from the underlying asset. So for example, if you had gold, derivative of gold, so the value of a gold futures contract is derived from the underlying asset of gold. They're not actually owning the gold, but they're looking at the value of it to get the value of the contract. And that's the end of our video too. I'll look forward to discussing this in class with you.